Hi, good afternoon. I'm Tom Tobin, Head of Healthcare Research here at Hedgeye Risk Management. I'm joined today with Emily Evans, who runs Healthcare Policy at Hedgeye, second on that arena. And she's thrown her hat in the ring here today on Clover, and has a very detailed deck that she's going to talk about some of what Clover is and some of what Clover isn't in terms of perceptions and reality. She's got a long history in health policy. She knows her stuff inside and forward. So take it away, Emily, and we'll come back at the end. If you want to put your questions in the chat box at the bottom, I'll moderate the Q&A at the very end when we come back.
Okay, great. Thanks, Tom. So I want to start, I'm going to just divide this up because I know we have a few people on the call who don't have as much experience in healthcare as we normally do. So I want to sort of start a little bit about healthcare and SPACs. Then I'm going to give a quick little primer on the space, Medicare Advantage, and then we'll move into what this company is, what Clover is, what it is not, and then you can draw your own conclusions from on that basis. Rather than relying a lot of storytelling that's been going on around this name, I want to provide a little bit more grounded information for everybody out there. But so to start, as we know, SPACs are really hot, and as we also know, SPACs do not require the same level of disclosure that an S1 does. It doesn't require the same procedure. And so a lot of the disclosures that you read in the proxy statements are very thin relative to what you would see if it was an S1. And maybe that's not that big a deal if it's, something that's not highly regulated, retail, technology, and so forth. But the healthcare space is very, very highly regulated, and for good reason. People engage in the healthcare system because they're sick. They often die, and the stakes are very high. And a great example, and in addition to that, because it's highly regulated, the stakes for violating regulations are also very high. The False Claims Act is a go-to tool for the federal government. And when you typically have an S1 or you have a merger, a traditional merger, there's a lot of scrutiny of Federal False Claims Act. There is almost always money set aside as a contingency for the outcome of that False Claims Act and other types of regulatory violations that may be unforeseen for the acquirer or for the public investors. And that's simply just not in evidence, when you have a SPAC. Because that disclosure is so weak, then I started looking at it with a pair of eyes, starting with Clover that has a lot of experience with the space. And you'll see, I think my conclusion at the end is the disclosure on this particular one has been, particularly weak in light of they are in a regulated space in a very regulated market. Before we get into the details of what I've found in my research, for those of you who aren't healthcare investors, for those of you who are, just stick me on mute for a sec. Quick primer on Medicare. There's two major pieces to it. Traditional Medicare was created in 1965. And that is where patients, if you're over 65, you're automatically enrolled in the hospital benefit. You can opt into the physician's benefit. And your physician bills the federal government and gets paid for his services on a fee schedule that's established annually. Medicare Advantage is a privatization of that system where insurers like United Health Group or Humana get paid by the federal government a monthly fee to take care of you, to take care of all your care, whether that's hospitalizations, physician services, or whatever. And if they're bad at it, they lose money. If they're good at it, they make a little bit of money, but they never make more than 15% because of other laws in place from the Affordable Care Act. And then the federal government creates these direct contracting, or these models, these ways to innovate on those two ideas. And the most recent of which is the direct contracting model, which has gotten a lot of play here, both with Clover talking about it, and also Cano, which is supposed to emerge as a SPAC, also talking about it. And these are just innovations. They are baby programs, small in scope, trying to see what works, what'll scale, and what will not. Medicare, if you go on the next slide, Eric, Medicare spending has gone up and to the right. It puts a lot of pressure on the federal government and in the federal budget, and it crowds out other priorities. And there is a strong policy interest in trying to alleviate some of that pressure. So part of the story that's told about Clover is that it's going to bend the cost curve, a phrase, quite frankly, I haven't heard since probably 2010, but that's what they're trying, that's what they're endeavoring to do. That's how they're talking about it. And they're using this very unique, what they say is unique technology platform in order to accomplish that. And that's the story, I think, in most objective terms. But looking at taking away the story and the CNBC appearances and all the star power of the people that talk about it, from the perspective of, an analyst, what is Clover? Well, it's basically an insurance company in New Jersey. It has through Q1, it has about 64,000 members. And you'll note the chart, the way it has this jagged pattern. You enroll in Medicare Advantage plans, which they run. It's Clover Health is what it's called. You typically enroll in a period of about 8 weeks in October of each year, October and November. So that's why you see that jump up at the beginning of the year. And now we've only got data on the first month of the year, and you see it's not quite jumping up as much, but almost, a lot of their members are in New Jersey, the vast majority of them. And their growth is primarily in New Jersey. They added 13,000 members, for example, in Q1 and 2020. I'm using Q1 2020 because we still have a little bit incomplete data on Q1 of 2021. 10,000 of those were in New Jersey. So if you look at the next slide, this is 2021 using that data that's still a little incomplete. They are experiencing little growth, primarily in Georgia. And Georgia, we'll talk about that in a minute, is the result of their relationship with Walmart down there. But still, even with the incomplete 2021 data, this is primarily an insurance plan, a local insurance plan in New Jersey. If you go to the next slide, this is some of the Georgia gains. We've seen, based on this, again, incomplete 2021 data, you can see that the Georgia has experienced a good bit of growth, but still, relative to other states, these are tiny memberships. It's Georgia's, now at throughout the whole state about 2,800 people, and and that's driven, like I said, largely by the Walmart relationship. Walmart, to great fanfare, got into, announced late last year that they were launching Walmart Insurance Services. Walmart, as I think everybody knows, has been pushing into the healthcare space through their Walmart health clinics. But when you read the press releases from Clover, it sounds like, this could be a great partnership. But really what it is a bake-off. Walmart has engaged with a number of health insurance companies to run plans for them as they, explore which ones do better than others. And so there are a number, Humana's involved, Anthem, Simply Health, WellCare, Clover is one, and there's the Blues are in there as well. There are, I think it's about 8 counties in Georgia in which Clover could sell insurance through Walmart and with Walmart, using their health clinics, of course, for primary care. going on to the next slide, Clover is not a particularly standout when it comes to enrollment growth. If you look, you know, at the enrollment growth on the right, that's all MA plans, and on the left, that's Clover. They're doing a little bit better, slight outperformance, you know, on a comparable basis, but mostly they're growing with the population. So that suggests that, you know, they really don't have any super secret sauce here. They're middling along, so to speak. And on the next slide, you could see, you know, their share gains are modest. I've never really seen this before, but the company talks about how, you know, they're getting 50% of new eligible enrollees, and I couldn't figure out how they got that. The way they define their markets as established markets, you know, they don't say if that's the county or a tri-county area or whatever. So, or the state, it's really hard to tell how they measure that. But if you look at the increment of, you know, additional enrollees in Medicare Advantage and how much they're grabbing for their plan, you know, it's about half a percent, kind of what you would expect from a regional or local player, and not what you would expect from some disruptor or somebody who's changing the world, which I'll editorialize in a minute. You're probably not going to change the world with a health insurance plan, but Clover also is it's not good at what it does. These are underwriting losses, and as you could see, they're pretty substantial, and they caught a break in 2020 with COVID. And this is, by the way, what we've gathered from the National Association of Insurance Commissioners. We're still waiting on the fourth quarter, but the amount of money they pay out for benefits and the amount of money they take in for premiums, you know, they have a shortfall, and they've had. In December of 2019, for example, the parent, Clover Investments, had to inject about $20 million in order to meet the solvency requirements for the state insurance commissioner. One of the things that I think is underappreciated about Clover, because I think it's underappreciated that what it is a health insurance plan, is the fact that the regulation at the state is very keenly aware of and monitors very closely underwriting losses, solvency, and things that they concerns that they have on the financial stability of the insurance company. And this is a longstanding feature of insurance in the United States, because insurance is something you pay for, but you don't necessarily use. And you want to make sure, and the insurance commissioner also wants to make sure, that the company will be around when you do need that, and that's why it's so heavily regulated. But up until COVID came in, they really weren't good at managing their spend, which suggests that, you know, this secret sauce that they say they have, you know, isn't really in evidence. And this is something, Tom, you've talked a lot about, the delays in care that have taken place during COVID. You could see that they've been the beneficiary of that, obviously, but that does not, you know, a profitable company make, and not even a profitable company, but one that can regularly meet the statutory requirements of its state for solvency and for capital requirements. If you go on to the next slide, one of their pitches has been, well, we'll increase members, but we'll also increase the net premium per month, because we'll be capturing more information about how sick the patients are that the docs that use the Clover Assistant are seeing. Okay, that, you know, it's been kind of going sideways. It's about what it should be, you know, roughly $1,000 a month. That's pretty standard back of the envelope math that you would use, but no real evidence that they're capturing, you know, this higher acuity or these diagnoses that have been gone unnoticed and therefore haven't been included in their annual payment from the federal government. I think that, you know, this information the government gathers and then applies is on a little bit of a lag, but really no evidence that it's getting better at this point. Their benefit expense, also, not terribly good at it. You could see the net premium line on this slide is, below their benefit expense. That's underwriting loss. And of course, they catch a break because you could see that some of that benefit expense, particularly this something called outside referrals, which I've got to look into. I'm not really sure, what's going on there. It's not a common feature of these filings, but you can see the hospitalization was up a little bit, but generally speaking, there's the seasonal pattern that we see in all Medicare Advantage plans is there. You can also see that there doesn't seem to be a particularly good benefit cost controls going on, and that's of course demonstrated by the MLR. And one of the things, that monthly payment that you get from the federal government, that payment is directly related to how much it costs to take care of a patient in that market. And they're not even performing versus their own market, and they're certainly not performing well versus the rest of the country as well. Another interesting feature of the state filings is their unpaid claims over 120 days have increased a good bit in 2020. It's still relatively low versus their unreported claims, and so that's why the chart looks like that. But it caught my eye, and I'll be interested to see if anyone has any input on what's going on there. So Clover is as I said, it's an insurance company. And MLR is medical loss ratio. That's how much you spend on the benefits, going back to that other chart, versus how much you get in premiums. And these are the MLRs that are reported from the state to the state through the state filing. And it's different than what gets reported to the ACA. There's different methodologies, but I'm comparing apples and apples here. The Oxford plan of New Jersey is the second largest plan after in the same counties as Clover. And I compared that, and you look at, and Oxford is owned by United Health, and you look at just how steady Eddie that MLR is over that 3-year time span, 83%. Just right there on the number, 83.04, 83.09, 83, but still right there, 83, which demonstrates market power, buying power within the health community, the health services community. It also demonstrates good cost controls, people who know how to manage spend. And here you have what Clover is reporting is at or near 100% for their New Jersey, the health insurance New Jersey subsidiary. So, again, no evidence that they've got a particularly great secret sauce that can control their spend, deliver high quality care, and give everybody, investors, an MLR that appears to be managed. The other thing about Clover, that suggests they're not particularly good at their job, is the star ratings, which are created by the federal government, and it's a quality program, and Clover is measured against other plans, and the data is readily available, and they have been stuck as a 3-star plan so I went back to 2016. And cannot seem to get out of there. They're not making the investments in the technology they need, or they're not making the investments in the people that they need. They're unable to contract with the high quality providers. There could be a host of reasons for this, but they are a 3-star plan. A 3-star plan is, as you can see on the right-hand side, of the vast majority of plans. This is weighted by enrollment on the right. The vast majority of plans are 4 and 5 stars, 4, 4.5, and 5 stars. There are the laggards that are in the 3.5 and 3 range, but there's really no. It's not great. It's just not great performance, and it's not great performance in areas that the company has said that we're going to excel at, because we've got this secret sauce, which is the Clover Assistant. And a great example of that, for example, is, they're having trouble with patient satisfaction. There's surveys that go with these star ratings, and patient satisfaction is not particularly high. Their disenrollment numbers around 14%, which is not too terribly bad, but not performing in a high quality way. And if you go and you look at the larger players like Humana and United and Anthem, they probably would fire somebody if they didn't get to the 4-star level, or at a minimum, the 4-star level. But yet Clover sort of persisted here, just suggesting they're just not good at the insurance business, which means that they can't capture providers in their open network or otherwise. It means that they can't capture clients. It also means they don't get a bonus from the federal government. The federal government pays bonuses for higher star ratings, and they're not able to avail themselves of that, and they're not going to be able to until they get those star ratings up. So Clover, what Clover is not is a it's pitched as a technology company. And, I went through all the materials on the website and talked to a good bit of people in the Medicare Advantage space over the last few days. And this platform is, and I think, Tom, you're finding the same thing, not particularly innovative. It is pitched to docs, it's pitched to the investors and the world as a way to improve care. It's pitched to docs as a way to increase in reimbursement. And those two things they're not mutually exclusive, but they're also not the same thing at all. And the other thing about it is that it is focused almost entirely on primary care, and doesn't, seem to offer things outside of a fairly select group of questions or lines of inquiry for primary care physician. The other thing that I think is important to remember is that the physicians are paid to use the Clover Assistant. And this has been, I think, particularly useful for physicians, and this probably explains why Clover's membership is primarily in 2 areas of New Jersey, the Fort Lee area and Jersey City. You have doctors in the primary care space operating in poor and minority communities, operating on very thin margins. And so, they're probably happy to double the E&M reimbursement that they otherwise would get. That, of course, the reimbursement for evaluation management primary care went up about, depending on who you are, what area of practice you are, between 5 and 10%. It's starting in January. So the motivation is going to be decreased because you don't have the full with this website. So that may have an effect on their ability to attract growth. Then here's another shot of from their deck. This is to get the doc to do something different. But if you read the fine print, this illustrates functionality that they're in the process of working on, and it's not actually functionality. So what the Clover Assistant is, who knows? I know, Tom, you've talked to some docs, but everybody I've talked to is, it doesn't like it, doesn't use it. And if you look at, in the next slide, you look at the benefit expense, I made this point earlier, you don't really see any evidence that it's controlling costs, that it's keeping people out of the hospital, that it's keeping people, on their meds so that they don't have a stroke. This looks like it's always looked, and the only reason the bars are higher is because they have more members. So that's so I think that the idea that we're going to have a transformative technology answer here is I think, proven out. I mean, we had a lot of technology, answers and questions, back in the 90s, where people were like, oh, if we just do this, and it never works. What we know works is, letting docs practice medicine and not, giving them another website to visit. Now, one thing that Clover is also not, and they put a lot of emphasis on their investor deck in October, which is kind of interesting because most of the direct contracting announcements didn't happen until December. But they made a big deal about how they were going to be a direct contracting entity. And this was going to drive membership. And that membership, of course, would drive the pro forma. Well, if you go to CMS's website, and I've included the link there, they're not really eligible for models 1 and 2. Model 1 is really directed at primary care physicians and other providers and accountable care organizations. It has 2 components. One, if you're a primary care practice, for example, you can take 50% of the risk. So in other words, you get paid, say, $1,000 a month, just like a Medicare Advantage plan. And you would then manage that care, and you would get 50% of the savings for managing that care and 50% of the losses as well. So if you got paid $12,000 a year and it cost $13,000 a year to treat that patient, you would have to bear some of the burden, the $500 of the $1,000 overage burden. The global model is all the risk, and that's total cost of care from beginning to end. So if you have a patient in your accountable care organization, which is something that was born out of the Affordable Care Act, well, then you have 100% of the risk. So if you get $1,000 a month, like a Medicare Advantage plan, and it costs $13,000 to treat that patient that year, that's you eat that $1,000. The applications have been accepted. The direct contracting entities have been approved, and on April the 1st, that program starts. Now, the interesting thing is, and that's why the website links up here, I couldn't find a good way to put it in a slide, Clover's not listed as a direct contracting entity because they're not a PCP practice, they're not another provider, they're not an accountable care organization. And reading their deck, I think what they're thinking they're going to do is they're going to gather up these primary care physicians and have those primary care physicians go and get involved in this direct contracting model. But and I'm happy for anyone to tell me I'm wrong about this, but I can't, in the list of entities that are going to be part of this model here at the beginning, starting in April, I can't really find any connection whatsoever to Clover. There's, I believe it's 3 in New Jersey that will operate as a Bronx Accountable Care Organization, something called Vivily, I think. And as far as I know, Clover's not made any connections for us. And again, I'm happy to be, disabused of this notion. But as far as I can tell, when they talked about this in October, when there wasn't as much information, and it hadn't been fully developed, there isn't really a pathway for them except to have a primary care practice engage with CMS, and then they would help execute. That would be one solution. But the model's not built for them. The model is built to create competition for them. And so that's some questions that need to be asked. The second model, direct contracting model, is for Medicaid managed care organizations who can bring in the Medicare fee-for-service patients and manage the care of those patients. Clover doesn't have a Medicaid managed care organization, at least that I can find. It's not showing up in any of their subsidiaries. I know they don't have any Medicaid patients referenced in their filings. So they don't have any experience with Medicaid patients, don't have a relationship with the state of New Jersey, which would be a predicate to that. So I don't think this is a pathway for them to be as a direct contractor. And we're still working, they're still developing that. We're going to have some more information on that here, I think, in the next few weeks. But but that doesn't really look like a great solution to them. And then the third model is a geographical model. That's where the federal government is going to take in a jurisdiction, they're going to take everybody over 65 and assign them to different Medicare Advantage plans. And here you can see the geographical areas. Philadelphia is a possibility for Clover, but this model is still accepting applications, still being developed, and is certainly not something, I think the application due date is April 2nd. This is not something that is going to be a 2021 event, probably 2023 at the earliest, because of the way in which, all the risk adjustment and the planning that needs to go into it. So I'm at a loss to explain their heavy emphasis on direct contracting, without more detail. And I would be inclined to say this is not going to be terribly accretive to the company. Now, I think that maybe over time, working with Walmart, if that relationship develops, that there's a possibility for that. But right now, there just doesn't seem to be any pathway for them. And really that leaves them in the blocking and tackling of acquiring new members, every single doing it, by providing good care, by having high star ratings, by being preferred, and having a good network of hospitals and physicians, to help you with the care, and being able to execute some, good price power. When you have 50,000 members in the state of New Jersey, you might have some price power there. And in fact, this was pointed out by the short report at Hindenburg, is that the CEO of Clover has a economic relationship with the three major hospitals in New Jersey, in Hoboken, and let's see, I think up in Fort Lee, Hoboken, and I can never remember my New Jersey towns, but they have an economic relationship. So there's the ability to maybe leverage that for the hospital network. But when they pick themselves up and they take themselves, to Tennessee, for example, that's going to be a little bit trickier, even though they're headquartered just south of here. How are they going to be able to leverage and get the right price point? And that those benefit expenses and that underwriting loss, speaks directly to their lack of market power. And if you can't deliver good prices, you can't really be successful. So then last slide, I want to snag this from their results or their projected results. And I have to say the disclosures, both in their presentation and in their proxy statement, is some of the wildest stuff, I've ever seen, where they're measuring MLRs based on people who use the Clover Assistant versus people who don't. And they have these very inconsistent timeframes, and I can't even really, I went and got the data from the government because I couldn't even, understand what they were trying to say. But this is probably the clearest slide that they have, which is, their projected financial results. And as you can see, they're looking for about 74,000 members in 2021. They're kind of tracking right now in the mid 60s. Maybe they get to the upper 60s. That would be my guess. Maybe they get to 73, but first quarter, we've got all the open enrollment data in already. Now we're looking for any additional data that comes in during the special enrollment periods, people changing plans, et cetera. And that generally isn't hugely accretive. I'm not going to rule it out until we've seen March data, but that's looks like it's tracking more towards the mid 60s. And the projected premium revenue, of course, is connected directly to that enrollment growth. And that enrollment growth, of course, it also includes some assumptions about increases in reimbursement, but not, if the Clover Assistant is that great, it's pretty consistent with what, we see generally on an annual basis for enrollment. So So kind of to sum it up, this is Clover is an insurance company in New Jersey. It is a health insurer in New Jersey. It's not a technology platform, and that's not what the government pays for when people are enrolled in Medicare. It pays for care, and if they can deliver that care in a way that is better, that's great. But we're seeing just absolutely no evidence that that is what's going on. And if they're not delivering that care better, they're not going to attract, providers. And if they're not going to attract providers, they're not going to attract hospitals and everything you need to build out a network to be successful. Meanwhile, coming in from the left, the federal government has decided that it needs to create more competition for Medicare Advantage plans through this direct contracting model. So what you have is, and then let's add to that the fact that the political wins on Medicare Advantage, are not at our backs anymore. They are headwinds because the politics of Medicare Advantage, which is a privatization of Medicare fee-for-service, is also not desirable in the new political climate. You have Medicare facing insolvency in the next 3 years. That is going to create some reimbursement pressure. And then finally, Medicare as a thing, as an alternative, is a lot more penetrated, especially in urban areas, than it has than most people assume. People have been using as recently as last month, like a 37% penetration rate. CMS has updated their data, and actually that penetration rate is in some urban areas, in Florida, for example, as high as 63%. This is not a great recipe, to be a Medicare Advantage plan under any circumstances, and particularly difficult for a small player, with limited market power and limited abilities to pull the levers like a UNH, like a Humana can as well. So that's all I have. Finishing a little early, Tom, but do we have any questions? You have some questions. You're on mute.
I'm putting my own questions in the queue as well, but I'm also trying to get Eric to put through some of the other ones. Some of the folks that have a more, emotional, I guess, reaction to the opinion.
Have they called me any names like Twitter?
No. No. Are you manipulating the stock price? That's the first question. Are you manipulating the stock price, Emily?
Tom, if I have reached that point in my career that I can manipulate a stock price, somebody please let me know.
All right. So
Emily who?
Yeah. So the first one here, does Clover have any significant differentiators when it comes to telehealth, given management's tech background, or is it truly run-of-the-mill? And just before you answer that, it sort of runs through a lot of this is that there's another one down here that says there are other MA startups, Alignment, Bright, and others. There are, and even Optum, and we know some of our friends in Nashville are really positive on Optum and how UNH is using data, et cetera. Is there anything, that they're doing that you've identified as differentiating?
No, and they do have a telehealth function. They have a little practice subsidiary, that I think has probably served well during COVID. But as we found in our research, you with Teladoc, Tom, is that everybody stood something up during the pandemic. So I don't consider that particularly accretive. And because they're Medicare Advantage, they're still stuck with the rules of Medicare Advantage when it comes to telehealth when the pandemic goes away. So I think that maybe creates some resistance for really investing in it as well. But I haven't seen any evidence. And it simply doesn't show up in the quality. If there's something special there, quality should be improving. The cost should be coming down. Something different should be happening. It's not. Okay.
And then there are a bunch in the queue, and some of these I think deserve pretty short answers. So if And this is what. So what did Chamath get wrong?
Say that again?
What did Chamath get wrong? Which is a real. I almost don't want to answer it, but it's the second one in the queue. So.
Okay, what I think he's getting wrong is, number one, I do not think he fully understands and appreciates what Medicare is, what Medicare Advantage is, and how difficult that is. This board of this company these are tech people. With the exception of the former first daughter, Chelsea Clinton, I don't see a ton of evidence that they've really attracted a lot of talent from the health sector. And I think the thing that they're getting wrong, and we saw this a lot in the early 2000s and mid 2000s, especially after the Affordable Care Act. Well, if you just had the technology, just had better technology, you would solve all these problems. That was the premise for the Affordable Care Act exchanges. Remember the president saying, "Oh, it'll be just like Expedia," Well, it turns out it's a lot tougher than that. A lot tougher than that.
This is my question, but it got voted up, so it's a good one. So how do Medicare plans enter new counties, and how does that impact the pace of the expansion? And I'm asking that in relation to the target of the 74,000 that they put out there, because they are highly concentrated in those 13 that they talk about, which
right.
is excluding special needs populations, which I'm not really sure what that means.
Right.
But then the second piece is they're only in 58, I think 50 something counties. They've got a 1.2 billion on their balance sheet. Like, how hard is it actually to hang out a shingle and get, like, how lengthy is that process?
So it is, once you have a contract, to answer your the lengthiness, I would say entering a new market without someone greasing the skids like a Walmart, okay, where here you will be a MA plan and you will serve people through our primary care Walmart health clinics. So leaving that aside, for example, in Tennessee, they're in, quote, in Tennessee. I think they have a few hundred, like 20 members or something like that. But I would say that entering a new market is probably an 18-month proposition, because what you have to let the insurance commissioners know you're there. You can't just start selling insurance in a state, and you have to be approved by and meet all the relevant laws, which is always curious to me why, except for the connection to the Care Health hospitals, why New Jersey is a very highly regulated insurance market. I would start Texas, for example, if I was starting a new healthcare company. But I would say about 18 months, because then you've got the pricing, you've got clarity on the pricing, you can get through the regulatory process. You don't necessarily need new contracts with CMS. For example, the contract the main contract, the one with all the people in it, is numbered H5141. And that operates in most states under its New Jersey license. So 18 months is probably a fair amount of time.
Okay. And is there anything driving? Oh wait, sorry. I scroll up a little bit. Unpaid claims greater than 120 days is a huge compliance flag in this regulated area. It's possible that this increased in 2020 with modifier codes being reviewed in greater scrutiny by the coders, but it's still troubling. And I guess, I'm not 100% on what the modifier codes comment means, but anything you want to add on that? And I would also just think that there might have been I wonder how that compares to everybody else, their 120 days.
Yeah, and because it's 2020, with
pandemic.
Yeah, could that have been a factor as well? Although if you're a technology company, you would think that you would have an advantage there, not a disadvantage at getting things, out the door. It could. I don't know about the modifier codes, and I suspect I know who is asking that question. But it jumps out at you when you look at the time series on their unpaid claims. But it's something I want to learn more about.
Okay. Is there anything in the Hindenburg research report that looks like they missed the mark? Things you think that are, or things that you think that are critical for the bear case to be right?
See, and when I look at, I feel the same way about Hindenburg as I do about Citron. Is it's all very cut and pasty, like articles out of you can just go and look at most of the data. But I think that the Hindenburg report focused on two things that I thought weren't that big a deal: the False Claims Act inquiry from the Department of Justice. I'm not saying it's not a big deal. I'm just saying it happens, unfortunately, a lot in healthcare. If the company and part of the merger has not reserved from any adverse claims as a result of that, that could have some problems, because reserving for false claims is generally a big part of merger negotiations in healthcare. I thought that the way in which Clover helps docs capture the right reimbursement, I didn't think that was a particularly big deal. Most prosperous practices across the country have consultants that examine their coding and billing practices and tell them, okay, you should be doing this a little bit differently. And there is a big cottage industry dedicated to that. So, not so big a deal. The one thing that I thought could have serious implications is the possibility that what Clover is doing is steering people to Clover via different inducements. Because the Clover Assistant is optional, that would probably not be an inducement in the eyes of the federal government. But if we're handing out, gift cards to sign up for Clover, or, we're doing anything that makes people behave outside of their own, outside of their own analysis or recommendations from friends, I think that has potential to be a problem. But the only way to really explore it is for the regulators to get involved and take a look at it and ask questions. That's not something that's noble to us. I'll also say in the Hindenburg report, they spent a good bit of time on these relationships, like between the CEO and the hospitals. These are disclosed. These were in the proxy statement. And I went and looked at it. The three hospitals don't charge that much more than other. New Jersey's an expensive state, so they don't charge that much more. I know there was a New York Times article, but I don't consider that something you can rely on for what we do. But I think, and I think that my big takeaway from the Hindenburg report, and my takeaway from talking to people in healthcare and particularly in the Medicare Advantage space, is that there's a lot in the air here. And Hindenburg happened to shoot, and I think mostly miss, but there's just a lot of talk, whispered conversations about this company and how successful it can be, and whether the story it's telling is true. I think that's what you should take away. And I think one of the tells here is going to be how many sell side analysts sign up for coverage. How many of them want to cover this company and risk all of the things that come with that, when you slap a buy rating on something that isn't all that it pretends to be.
Okay. This is a question, I think, from a friend of yours, but is an NMA carrier owning a broker subsidiary not typical?
I'm glad you brought that up.
Let me finish. The Clover response said it was industry standard. But I don't believe that's the case. Most of the time, wouldn't MCOs drive leads or volume from people like eHealth or SelectQuote, et cetera?
That's the standard. And in fact, if you look at their disclosures to the states, they state that they will be driving most of their business 85% from brokers, 15% direct mail, direct content. But showing up, I think it was in 2019, as a subsidiary in the state level filings, is Seek Insurance Services, which is what we're talking about here. And when you report your subsidiaries and whether you own them and so forth to your state regulators, you have to tell how much of the company you own. And one of Clover's responses to Hindenburg was, another investor owns it, we have a share of it. I think that was their answer. Well, they don't actually disclose their ownership as required in the filing. And I guess it's just the regulators have missed it. It's just blank, so we don't really know exactly what the relationship. It shows up as a subsidiary in their organizational chart. I think it's one of these steering questions that I think that regulators are probably going to, with all this publicity, going to probably take a good look at it. I don't agree that it's industry standard. Industry standard is a disinterested arm's length broker advising, selling a service and getting paid for that. That's what normally happens.
Yeah, then the extra $100 on the unit to put the data in through the Clover Assistant. Have you done any work on that at all in terms of what they're turning around, how it's handled? There is a question in the queue here about some of their overseas efforts here and the compliance related to, it's sort of privacy. I would think OIG, OCR, like these kinds of agencies that would be interested in how that data gets handled on the back end.
Yeah, and let me respond to that second part of it. I think you've done more work on the docs that use Clover Assistant for your fundamental work, but that the data, health data traveling offshore has been elevated as an issue for the federal government. You saw the 60 Minutes report a few weeks ago talking about the Beijing Genetics, trying to pitch its services during COVID. I think that's going to be debated and discussed on the 23andMe SPAC as well. Where's that data going to go? Who's going to use it? And it isn't just a national security thing. I think what the federal government is worried about, and it has been worried about, is once you are able to gather, data on a person's health, and you have their social security number, and you have their birth date, and you know where they live, you're able to do a lot of identity theft, medical claims are some of the most valuable data out there. Because you can steal identities, you can bill the United States government, for those services, and nobody is ever going to catch you. So that is a concern. It is probably not quite as high as the steering concern that could relate to Seek or any other inducements. And it's still early in its development as an issue, but I think that you're going to see that's going to be a concern. And I know that a lot of practices, particularly prosperous practices in areas of the country with demographics that aren't nearly as challenging as Clover's, that's something that'll be a concern as well. So, but I don't see any regulatory intervention. But Tom, why don't you talk a little bit about some of your primary work talking to the.
Yeah, I mean, what we picked up on was sort of a dual process. The data is not integrated with the EHR at the practice, and that somebody has got a handful of patients and they're on the Clover system, and then they're essentially being asked to input a bunch of data to fulfill the claim. It's a slightly time-consuming process. It's one that they're willing to do, though. Didn't hear a lot of positive, it did not hear it, but we didn't hear a lot of impact on sort of patient care or the delivery of the data or the fulfillment of, the great story, right? And it was much more about the extra $100 and having that be a part of it, but also that there was some frictional costs, that it wasn't a large number of patients, but if it got to be a large number of patients, that would be incrementally a problem
right.
in terms of the office staff that handle that dual process, that it wasn't completely free money. And then the auto enrollment piece I think is interesting, just from they have this preferred provider network that you can find on their website and see those docs that are more tied in. Are they the ones that are sort of driving? Because I think the machine would be the way the flywheel would work is that if I'm a doc and I'm getting paid an extra $100, I'm then an advocate to my patients that, hey, you should think about using this MA plan. And it doesn't sound like they're going to get that from at least what we've heard so far. it does, but there's a lot more to do for on our end. Like we're gonna try to figure out how to track some of that data and definitely talk to a lot more people. But
well, and
yeah, the initial anecdotes weren't super.
Yeah,
they weren't glowing.
Well, and back to the steering question, a doc, they're really trained well in the steering issues, would be hesitant, and that's I think why GoodRx has that flyer. You just put that flyer there, and person takes it or they don't. But saying to a patient, you should use this is little, not over the line probably, but definitely an uncomfortable place to be, given the anti-kickback statutes and the steering statutes for physicians. Just easier not to do it,
Right.
Yeah.
Okay. So moving on the queue here, is there a reason for Clover to be purchased? Are they a takeout in your mind?
Okay, so you get to call the longs and the shorts here, but the one thing, if Walmart discovers that Clover is delivering a high quality experience for its customers, maybe that's a possibility. But this is a it's a lot of money for that. That evidence that they are doing that and able to do that is not there. I think the probability is higher that Clover gets excused from Walmart or doesn't get to expand because they just aren't delivering this high quality experience that Walmart is going to need in order to put their name on something. But I would say that Walmart's a possibility. But what are you buying here? You're buying, if you take it out, you're buying members, which you could acquire. I mean, it's not a ton to acquire at this point. The other thing you're buying is this technology, which doesn't look like it's particularly special. So my only thought is Walmart. Do you have any?
I mean, the next question here is the valuation piece, and I think it's interesting. I would be terrified to be short this here because I think it's a great. I got the deck. I was like, this is a great story, and the second half of that sentence should be if true. we don't know if it's true yet, and I think from the market perception and where I feel uncomfortable betting against something like this just because there is a huge fan base. They've got this backers list is crazy. So there's a certain confirmation bias that's already built in,
right?
To go up against it. But yeah, I mean the data points didn't come back universally positive, and in fact a lot of it just their market share gains in those certain markets in New Jersey don't look as robust on the chart we built using our analysis. Given their footnote on this is our top 13, it excludes special needs populations, and it looks all very tidy. But then, maybe it isn't as close to the reality. But if you've got a company that looks like it's got, $1.2 billion in cash, pretty clean balance sheet, good backers, and sort of a delta between where they are at 64,000 and 10,000 more to get to 74,000. Those targets don't look crazy to me, and it doesn't look egregiously valued. I think it's 5 times rev at this point. And which for if it is a tech platform, it will be something more than 5x. If anybody gets a whiff of that, this is a believable story, or the data doesn't come your way on the short side, I think you're in. Especially now. I mean, it's obviously a polarizing. There are a lot of feelings out there on this. And
I've noticed. Would you buy it?
I don't know if I would.
Short, but is it?
I don't know if I would go that far. I think we're watchful waiting on our end and trying to build the tools. I got to build a tool to figure out to watch their providers come on in terms of preferred providers. We've got to figure out a way to. I think the issue of claims development in this post-COVID era, particularly for an MA plan, I think is going to be interesting. There might be, the mechanics of how that happened. Are they going to get incremental reimbursement, or are they going to be eating it on the reserve development? because I think, I mean, I'm hearing a lot of incrementally more evidence that, post-COVID long haulers I mean, there's a lot of disability out there from this, even for those mild cases.
Well, and if you consider how hard hit New Jersey was in the New York metro area, and the company reports this, we had a lot of claims for COVID hospitalizations, but you consider the delayed care that we've talked about, and this is showing up in the chatter about Anthem and some of the other managed care names. It's going to be, you've got at least a year before you really know how that, I think, is going to play out. And don't forget, the rates were set, sometime in mid 2020. They weren't set based on, what we think we're facing here. And I think that's true. And I'm, kind of down on managed care generally because of it and some other things. But I think that, they're a weak player from MA perspective with a lot of headwinds, policy and regulatory and delayed care and COVID and everything else.
Well, answer me that then. If somebody comes in post-COVID and now they have some cardiac issues, some lung issues, some mental health issues, like memory loss and kidney function, like a whole host of stuff that could be really wrong with them at this point.
Right.
Are they going to get, when they come in, are they now going to get incremental MA reimbursement for them?
Oh yeah, but it's on a lag, and this
how long is the lag?
It's the fee-for-service benchmark is calculated. So for 2022, it would be calculated in early 2021, based on data collected in 2020. So basically, call it 2 years. And that's why you need so much capital and so many other levers to pull than what these guys have.
All right. Let me see if there's any other questions that I'm missing in the queue here. This is a newish one, but just can you comment on their international business and why is an MA plan a company doing business internationally?
They have an office in Hong Kong, but as best as I can figure out, their international presence is software R&D. They've offshored some of and this back to the question we had about data traveling outside the country. It looks like it's software R&D and not insurance services. And in fact, the SPAC had to domesticate, because we have laws in most of the states of this country that in order to be in the insurance business, you have to be a domestic corporation. But that doesn't mean you can't serve the insurance business from overseas. And I think that's what they're up to. Yeah,
that's it. I mean, there's an element here too, that if they ever did integrate that Clover Assistant into the, sort of into the workflows, like an Epic workflow or Cerner, or Allscripts or, any of the EHR companies, if you hook that in somehow or plug that in, as opposed to having this parallel process, it does seem like it seems like it could work. I mean, there's it's still got the whiff of possibility all over this.
It does, but I think one of the things that argues against that is, amongst people who do this every day, they're not tech people and they're not famous, whatever, they're blocking and tackling through this system every day. This company doesn't have a great reputation. As one person put it to me the other day, yeah, it's like a bunch of Google engineers decided that they were going to fix healthcare, and then you had a bunch of money pile into that idea, and you had, we're still a bunch of Google engineers trying to fix healthcare, and then you had a bunch of money piling in after that, and at no point in time so far that I've seen has someone gone, okay, we're in the insurance business. We need to act like we're in the insurance business. We need to get people in here who understand the insurance business, particularly in New Jersey, and start building out that capability. And I think if this were a startup or even a Series A, and this were 2010 or 11, I would say sure. This is worth a go. But this system has advanced way past this value-based, You know, all we need is good technology and data. We are well past that point, and we're moving into a consumerism trends. We're moving into experiences that are delightful, like your work on One Medical. This environment, this market, and everything about it is changing, and I don't think the company acknowledges that.
Okay. Well, I think that's a really good place to end. We're at the a little over the top of the hour. Thank you so much for taking the time to listen today, and thanks, Emily, for taking us through your findings on Clover.
Thanks for joining us, Tom.